So today I want to talk about the performance of stocks as investment vehicles. Now there's two seemingly contradictory imperial sets of data out there. One says stocks for the long run, Jeremy Siegel, stocks are the best vehicle out there for long-term investments versus most stocks do not outperform treasuries bills in the long run. And they seem contradictory. Now, of course, the first one, Jeremy Siegel and others have pointed out that over long investment horizons, stocks dramatically outperform other investment vehicles. We can see that in this chart here. It's a log scale, but clearly stocks dominate all of the other investment vehicles. Now, I have another video that you can see here that goes into this in more detail. But what I want to talk today is about Hendrik uh, Bessembinder's research. And what his research says is basically most stocks are terrible investments. You might as well throw your money down the toilet. So what's going on here? They're both right, but the difference really here is Siegel is talking about markets or baskets of stock, and Bessembinder is talking about individual stocks. So he has two papers out there that the rest of this video is based on. You can see those here. He wrote both of these. Very interesting, worth a read. But the key here is he's talking about individual stocks. What he does is he looks at the CRSP database going back to 1926. There were 2,000 or 23,500 companies in there. What he found out is if you look at their monthly returns, less than half of these returns are positive. So Treasury bills, of course, have a slight positive return over time, but more than half of the companies have zero or negative returns on a monthly basis. You can then take this and look at it on an annual basis. Again, you can see lots of stocks here having right around a zero return, but plenty of stocks having negative returns. And these big returns are few and far between. It's worth noting that the average stock in the CRSP database is only there for 7.5 years before it goes away. And a lot of reasons they go away is because they go bankrupt and they go to zero, essentially, right? We can then go to decade-long holding periods. And now what we're seeing here is once we go to a decade-long period, we're seeing that the most common return for holding a stock for 10 years is for you to lose 100% of your money. 100% of your money. That is the most common outcome for holding a random stock in the CRSP database for 10 years. The picture, as we go to lifetime for stocks, this only looks even worse. Only 42% of stocks do better than Treasury bills. More than half deliver negative returns over their lifetime. This is not a pretty picture. Definitely not the one that we think of when we think of stocks for the long run. So what's going on here? What's going on here is that these return distributions are heavily skewed. There's just a ton of stocks that just do very, very poorly. They just are not good businesses. And all the stock market gains that we think of, those are occurring from this relatively small number of stocks that actually do well. Those make up most of it. So if you think about the best performing 4% of listed companies make up basically all of the gain that we see, and the remaining stocks altogether basically match Treasury bills. So it's just a question of concentration and just a very limited number of companies that are successful, stay successful. Here you can see kind of a distribution of all of the wealth accumulated. Looking at all of these 23,500 companies, what you're going to see here is kind of, if you look on the left there, that the wealth grows very, very quickly. So those are those very few companies that do very, very well. And then you have just a ton of companies that are adding almost no value whatsoever. And then you have a fair amount of companies that are detracting value. They're losing money by investing in those companies. If we kind of get rid of all the crap and we're just left with 1,100 firms that did very well, that's basically all the wealth accumulation is in those relatively small number of companies. So roughly less than 5% of the companies, 4%, do most of the wealth that we see there. Key here is go check out Bessembinder's work and read those papers, and then just be smart with your investments. I mean, you really want to make sure that you're investing in companies that are viable, that have long-term prospects to make money, etc. Thanks so much for listening.